You might have heard about supply and demand around the internet, but did not understand what is it, and what is the use of it. In this video you will learn everything you need to understand supply and demand, and how to use it in your trading. So what is supply and demand? Supply and demand is the most important concept in the financial market. In basic economics, it is well known that supply and demand are what that affect the prices of items. Ideally, when there is strong demand, the price of an item will rise, and when the demand fades, the price will retreat. In simple words, supply is aggressive selling, and demand is aggressive buying. And supply zones are area, from where the price falls, and demand zones are area, from where the price shoots up. So, why supply and demand is very important in trading and why you want to use it when you trade? Well, when you see aggressive buying and aggressive selling, this means that smart money is in the market, because retail traders like us can't move the market. Here's how to identify supply and demand. As you can see, there is aggressive selling right here. You can mark the last candle as supply zone, because this is the candle that starts the whole move. Or if there is bunch of candle around this candle, you can mark all those candle as the supply zone, and a lot of the time you will see that the price comes to the zone and bounce off. Same as supply, you can see that there is aggressive buying right here, and you can mark this last candle as demand zone, and you will see that the price comes to the zone and shoots up. Here's an example. This is a chart of euro to US dollar. As you can see, the price moves very aggressively from here, creating a demand, and this candle starts the whole move. It means that this candle is the demand zone. Now the smart money will push the price to the demand to take the floating sell orders, and then the smart money will push the price back up. Now, how to trade supply and demand. This is a chart of Canadian dollar to US dollar in 15 minutes time frame. Here the price moves very aggressively from this candle to the downside, creating a supply. You can mark this candle as supply zone. And now the price came back to the supply zone and rejects. You can enter a trade at the low of this candle and place your stop loss above supply, or you can place your stop loss at the swing high and place your take profit 2 times of your stop loss and then let the trade play out. Or you can trail your stop loss whenever the price makes a new lower high for higher risk to reward. But if you don't want to sit for hours to trail your stop loss, you can just place your take profit 2 times your stop loss. It totally depends on your trading style. As you can see, the trade plays out very well if you have trailed your stop loss, and your risk to reward is 5 times of your stop loss. Let's assume that you risked $100, you could have made $500 in this trade. Here's another example. This is a chart of US dollar to Japanese yen in 15 minutes time frame. Here the price moves very aggressively from this candle to the upside, creating a demand. You can mark this candle as demand zone. And now the price came back to the demand zone and rejects. You can enter a trade at the high of this candle and place your stop loss below demand, or you can place your stop loss at the swing low and trailed your stop loss for take profit. This trade also plays out very well, and your risk to reward is 3.2 times of your stop loss, and you could have made $320 in this trade also. $500 in first trade plus $320 in second trade. You have made $820 just by trading supply and demand.